Hi everyone. My name's Sam Adham. I'm head of battery materials at CRU. For those of you who don't know us, we are a industry analysis firm for metals, mining, and fertilizers. We provide analysis through market analysis, price assessments, consultancy, and events. And our battery team is dragged across the entire lithium-ion battery supply chain, upstream, midstream, downstream. And what I've come to tell you about today is it could scare you a little bit. But it's a reality, and that is that the pace of change in battery technology is posing risks and opportunities for mining investments, and it outpaces that of the traditional timeline of development in the mining sector. It's shifting demand to materials at a time when mining and refining projects are still being developed. So I'll be trying to give a rundown of trends in battery chemistries this decade. I'll focus mainly on cathode materials as what constitutes the largest share of costs in lithium-ion battery. A bit of anode, and although there are interesting things going on with other metals like copper, I'll leave it out in the interest of time. And I'll focus firstly on the automotive sector as what's by far the largest segment of demand for lithium-ion batteries. My background is in the automotive industry, and in that spirit, hopefully I can give you some perspective on what your downstream end users are doing. And then my esteemed colleague, Martin Jackson, will follow that to describe how minute changes in demand can swing the balance between a bull and bear market, especially for that of lithium, and then what are the further implications for material demand and therefore mining investments. So let me start by setting the scene in the automotive battery sector. The global auto industry has embarked on this transition to battery electric vehicles, or BEVs. But to make BEVs, you need batteries. To make batteries, you need raw materials. And all battery raw materials are subject, to one extent or another, to price and availability concerns. And a significant bottleneck of at least one of them can hold back the transition to BEVs. On top of that, a number of other enduring risks include one-off economic shocks to the industry, like the pandemic, inflation, energy prices. All of that can continue the current trend of expensive vehicles and poses a risk if BEV technology cannot be democratized beyond the wealthy buyers. So there's a downside risk to the overall auto market volume and a downside risk to the pace of BEV growth. There may be a corresponding upside risk to BEV penetration in certain countries if those pressures can be alleviated, but there's not much room in doing so from the supply side, especially for lithium, which Martin will explain later. And alongside the major automotive production bases, a massive lithium-ion battery supply chain is being built in parallel. And that supply chain is overwhelmingly weighted towards China. And China will, to an extent, continue to lead the industry's direction in terms of technology and costs. EV and cell manufacturers are suffering from high raw material costs, and they're increasingly looking to low-cost battery technologies and material thrifting. And that's mainly through cathode chemistries. Usage of cathode chemistries varies by region, and much of that depends on the consumer expectations around driving range and cost, but there's many other reasons and factors at play. Today, the incumbent nickel-based batteries like NMC, NCA hold the dominant share on a global level. In China, LFP has grown massively in the past couple of years. Arguably, it seems to be slowing down and maybe even reaching a saturation point in terms of market share. And we're seeing early LFP usage in Europe and North America, although at the moment those batteries are still coming from China. But looking further ahead on the global level, the regional picture is very different. But on a global level, the last 5 years or so, it's been a competition between medium nickel, high nickel, and LFP. The two main concerns for EV and battery designers has, up until now at least, been cost and driving range. So the general trend in nickel-based batteries like NMC has been towards ever higher nickel content and therefore higher driving range. The current state of the art is NMC 90, that's 90% nickel, and there's plans to even push it even higher than that. And the low-cost nickel-free, cobalt-free alternative has been LFP. It's gone through a resurgence from around 2021, and it's starting to replace or make the medium nickel chemistries obsolete to an extent. But there are reasons that I'll explain in a minute why LFP will not necessarily be the dominant chemistry on a global level, despite its clear techno-economic advantages. And so nickel-based chemistries like NMC will continue to hold the dominant share on a global level, if only marginally, although that's not to say that LFP is necessarily decreasing. And then new cobalt-free manganese-rich chemistries may grow to prominence in the second half of the decade if automaker roadmaps are followed through. But there is a downside risk to these for technical reasons. So there is the possibility of LFP taking a further share if they're not commercialized. This is just showing lithium-ion chemistries. I'll talk in a minute about sodium-ion. But meanwhile, the legacy NMC 532, 622 chemistries will continue in parallel for the years until the renewal of vehicle life cycles, which are typically around 7 years in the auto industry. And that's a good thing, I guess, for mining investments because it at least puts a dampener on the actual pace of change downstream. But at the same time, the pace of change in China is very rapid. It's the exception to that rule. And new chemistries are still emerging. And at best, you can forecast with some confidence probably only 5 years out. And it's important to mention this is only one possible scenario amongst several. I've already mentioned an alternative scenario where manganese-rich chemistries are not followed through. And I'd like to dive in, though, why the forecast looks this way and proving what's driving the market towards or away from certain chemistries and, in a sense, give a reality check. But before I do that, what does all this mean for material demand, generally speaking? So for lithium, there's a general move to less lithium-intense chemistries over time. So LFP, LMFP, LNMO, high nickel NMC. And that's not just based on the practical lithium content within the battery, but also take into account yield losses at each stage of production conversion, all the way from the mine stage all the way to the battery pack level. But on the basis of total lithium consumption, we're already seeing more efficient use of lithium being made over time. But that alone isn't enough necessarily to solve the lithium supply-demand deficit. And also, if we apply the very crude assumption that anything above, say, 60% nickel requires lithium hydroxide as opposed to carbonate, then that would imply increased dependence on spodumene concentrate production, and future investments in refinery capacity would need to be more focused on hydroxide, generally speaking. For nickel, as I said, NMC chemistries are gradually moving to ever higher nickel content driven by range expectations, but also to reduce cobalt usage. And they, along with LFP, already starting to replace the medium nickel NMC 532, 622s. And for cobalt, the move to higher nickel NMC, the move to LFP, and the move to cobalt-free manganese-rich chemistries altogether dampen the growth in cobalt demand. And based on this scenario, we may see peak cobalt usage in EVs around 2028. In fact, cobalt is the only one of these materials for which demand may start to decrease in this time horizon. And for manganese, the emergence of these new manganese-rich chemistries implies a colossal growth in high-purity manganese sulfate production, which is currently dominated by Chinese producers. And I haven't mentioned anode chemistries yet, but despite the efforts to replace the incumbent graphite anode with various forms of silicon and later lithium metal, we expect those materials will play a relatively limited part in EVs in this time horizon, more intended to unlock the use of battery electric propulsion for other applications like aviation and long-haul trucking, which are much smaller markets. Silicon will continue to be mixed mostly in small amounts with graphite in anodes and EVs. So we'll still see significant growth in graphite demand for batteries in this time horizon. So coming back to why the cathode chemistry forecast looks this way, every man and his dog seems to have a view in it nowadays. And so I'd like to prove what's driving the market towards or away from LFP and NMC. And we'll start with automakers as the end users. How an automaker selects its battery cathode type depends on a number of things, but most of all is the type of application. The auto market is set to be bifurcated with, generally speaking, low-end vehicles using LFP and high-end using nickel-based batteries. And although it looks like many OEMs will use LFP, crucially, almost all of them will do so only for cheaper entry-level vehicle variants. And it'll take time for most automakers to proliferate LFP and new chemistries into their offerings. And so if most OEMs have committed to LFP only for entry-level vehicle segments, how big is that share of the vehicle market? So this is the trend for vehicle size segment based on battery capacity usage. The regional picture is very different, but on the global level, the EV market is trending towards the mid-size, upper C, lower D segment. So that's roughly Tesla Model 3, Model Y sized. No one can say for certain that will continue to be the case, but automakers are overwhelmingly placing their focus on the C and D segments in their corporate strategies. LFP was historically suitable only for small A and B segment cars, but then there have been improvements in battery design, electric motors and power electronics got more efficient, there was further lightweighting in EVs, and LFP's range disadvantage is no longer such a huge issue today. Essentially, those technical improvements have unlocked LFP suitability into the bottom of the C and D segment. So LFP is potentially suitable for 50% of the market, but partly because of automaker preference, that won't necessarily be the case. Because legacy automakers have a delicate balancing act to do in their transition, they can't just afford to stop selling internal combustion cars overnight, but they're also hemorrhaging cash, having to keep two value streams going on in parallel. Add to that the persistently high cost inputs to batteries and EVs, then automakers have to continue shifting their price point up market to larger or more expensive vehicles just to maintain profitability. And that is exacerbated by these times of other production constraints, such as the semiconductor shortage. We've already seen automakers prioritizing high margin, high-range vehicle variants for production with NMC batteries over low-margin, low-range variants. And so the paradox is that as long as battery and EV cost inputs remain high, entry-level segments and their usage of LFP and other low-cost cathodes will remain a relatively small part of the market. And just to mention sodium ion, which is touted as a low-cost alternative to lithium ion, at least in its current state, sodium ion is likely to make its way into the very smallest vehicles. And as we see here, the smallest A segment vehicles make up a very small part of the market. And so it would barely make an impact in the EV battery sector. And incidentally, the first casualty there will be LFP. Where it does have strong growth prospects is the stationary energy storage sector and perhaps two-wheeler vehicles, and in turn that would relieve some of the pressure on lithium demand. But all that being said, it's not a very fair comparison to make at the moment. On the one hand, you have years of large-scale data from the field, that's lithium ion versus sodium ion, which is basically a data sheet. So it remains to be seen how sodium ion actually performs in the real world. In the long term, battery right sizing or using smaller capacity batteries is another pathway to alleviating material costs and material thrifting. So this won't necessarily be a short-term trend because automakers that have introduced extreme right sizing for batteries have suffered from poor sales as consumers opt for competitors with longer ranges, even if they know that a smaller capacity battery would suffice for their daily needs. But in the long term, at some point, range will no longer be an issue, public charging networks will improve, there will be costs and even legislative pressures encouraging right sizing. And this scenario has already started to occur in China to an extent. but yet to occur in the rest of the world. The point of all that is it's a pathway to thrifting of all materials, and it's an enabler for further use of LFP and sodium-ion batteries. They're ideal options for smaller capacity batteries. And Martin will later present a scenario for how this might pan out. On the other hand, when we look at it from a supply chain perspective, China by far dominates LFP supply and demand. That includes LFP cells and LFP cathode material. And it will continue to be the way for the foreseeable future. And although several Western automakers have plans to adopt LFP batteries, the local pool of LFP cathode and cell suppliers is limited. You can see not every manufacturer is planning LFP into its offering. And even those in that research stage are a long way away from mass rollout. And the emerging Western homegrown battery manufacturers are focusing on only NMC for now. Because battery manufacturing is a high capex business with tight margins, the capex to establish a cell gigafactory is more or less equally ruinous whether it's making LFP or NMC. For startups and those with smaller scale than the Chinese giants, the only viable strategy is to sell high-value, high-performance batteries with a premium, and that means NMC. Those that are building LFP cathode plants and gigafactories in the West, apart from a couple of exceptions, almost all of them are startups or smaller suppliers that don't have contracts with automotive customers, and for various reasons likely never will. On the other hand, although the Western LFP supply chain is currently limited and Western battery manufacturers cannot compete on a cost basis with Chinese giants, US and European policymakers are attempting to one extent or another to subsidize domestic producers, although those policies vary in their effectiveness. So just to summarize the LFP situation, despite the clear theoretical techno-economic advantages offered by LFP, the realities of the supply chain and customer preference and competition from other chemistries will altogether constrain its market share on a global level. But that being said, 35% market share is still significant. But just to finish off with another application, it's not just EV batteries. The other applications and one that has the largest growth prospects is stationary energy storage, or what we refer to as ESS. So that's grid storage and behind-the-meter storage. And that must grow in parallel to the build-out of renewable energy infrastructure in line with nations' net zero goals. LFP is perfect for short-duration storage because of its low cost and high cycle life. And of course, in a stationary application, you don't really care about energy density or driving range. And incidentally, China has banned NMC from being used with grid storage. But this too is a sector where lithium-ion is challenged, most notably by sodium-ion in future. And actually, that light blue segment there is higher in our forecast because we're only showing lithium-ion batteries here. So hopefully that's helped you to make sense of the cathode material landscape and the upside downside risks to material demand from thrifting and substitution. I've barely even mentioned the various other technical improvements to the energy density of batteries and vehicles, driving even more thrifting of all materials. And there's also policy risks associated with battery materials. We also want to make it clear, though, just to finish off, that despite all those downside risks that I mentioned, demand for all those battery materials will continue to grow massively. Okay, finish off. Thank you very much, and I hand it off to Martin.
Thanks, Sam. So my background is in mineral exploration and also resource definition, but I have an academic background in mineral economics, so it makes a little sense that I'm taking on the baton to show you through the supply side a little bit here. So we're going to pivot to the lithium industry and specifically supply. We're going to use that as an example today. And I'm asked on an almost daily basis if the mining industry is going to be able to support the phenomenal growth that we've seen in demand for batteries. Ultimately, raw material prices are the largest source of cost volatility in the supply chain. So it makes sense that this question is being asked. So while industrial demand for lithium, that's glasses, ceramics, greases, also aluminium production, that's expected to grow by 3% over the next 5 years. Demand in batteries will grow at 7 times that rate. And as a result, demand for lithium will quadruple over the next decade. It's important to note that the specifications for lithium used in industrial applications are very different to chemicals used in batteries. Battery-grade product is not available on open exchanges like the LME, where the majority of the world's commodities are traded. Deals for battery-grade products still happen behind closed doors, and products often require years to be qualified by buyers. On top of this, supply is secured several years in advance within long-term agreements. And of course, if that material isn't secured, OEMs cannot guarantee their strategic growth in the market. If you're looking for materials delivered within 5 years, for example, your capital investments are required now. And of course, there's inherent risk in those agreements. That agreed supply may no longer be required in 5 years if a new technology disrupts the market. And I should actually be saying when, not if, because technology disrupting the market is almost an inevitability. So the golden question here is, can supply meet rapidly growing demand? And the only way to accurately understand this is a bottom-up approach to modeling. And that's building a distinct understanding of each operation globally that's either producing lithium today or is expected to produce lithium in the forecast. And of course, that must be matched on the demand side, which Sam has given you a taste of earlier. So if we compare lithium supply from existing producers against projected demand, it's clear that supply will not be sufficient. In fact, it wasn't sufficient over the last couple of years. The deficit in 2022 was equivalent to roughly 8% of demand, and that's even larger than the supply shortfall that we saw in 2021. And that caused spot prices in China to exceed $80 per kg. Price volatility is the consequence of these tight market conditions. When you start stacking supply from projects that we class as committed, and these are projects that are already in construction or have their financing already committed, when you start stacking expected supply from projects we class as committed, that's not enough demand to meet. That's not enough supply to meet demand over the next 5 years. You can see that shortfall in 2027 there. Supply from only the most marginal operations will be able to fill that demand. And these are projects we deem as probable and possible. These often rely on extraction technologies that are not widely in commercial use today. Many also depend on much lower grade resources, such as lepidolite or sedimentary deposits, or they may be located in regions that hold additional complications, such as Africa or Europe. And these are due to logistical or environmental constraints, for example. So this should give you some sense of how difficult it is to satisfy lithium demand. But the argument is often made that consumption specific to the battery sector is actually a lot tighter. So I'm going to preempt this argument and show you a little bit of what that looks like. Because battery chemicals are, after all, a lot more technical to produce. So here we're showing the global battery-grade hydroxide and carbonate capacity versus demand. The demand is shown in the yellow there, with the blue bar behind it indicating capacity available for each one of those battery-grade chemicals. And essentially, the closer we look at the capabilities of battery material processing, and the further downstream we look, the more we see overcapacity within the battery sector. Even in an exceedingly tight market last year, there was sufficient battery-grade refining capacity for both lithium hydroxide and carbonate. Further out, the industry will certainly require announced investments to be commissioned, especially for hydroxide production. But this doesn't come close to the degree of investment required in mine and brine capacity. And as you move down the value chain, the more congested the market gets, and the space for new entrants shrinks. And there are several reasons for this. Mining is inherently risky. I probably don't need to paint that picture for this audience. But there's also a greater reputational risk to investors. It's much easier to get backing for a battery recycling plant over a lithium mine in West Africa. And then, of course, there's a significant time required for exploration and development. One perfect example of this is Allchem's James Bay in Canada, which took over 6 years to get its environmental permits through. So I'm going to take you back to what we call a market balance, which is essentially taking a look at the degree of which the market is oversupplied or undersupplied. And that, of course, is critical to raw material prices. So here we're looking at the balance of the market expressed as a percentage of demand on the left-hand side. The dark blue is our reference case, our base case. And this is a careful balancing act of all the risks involved in both the demand and the supply side. You can see over the last couple of years, we've seen a persistent market deficit, and that, of course, resulted in prices significantly higher than historical averages. The supply deficit this year has narrowed significantly, and we've seen lithium prices respond to this easing situation. Prices at the moment are down around 60% versus prices back in December last year. So we're still expecting a deficit this year, driven by much stronger demand, especially from China in the latter half of the year. But we have seen an incredible supply response to these high market prices. Mostly that's come from key projects, especially in Australia, in Chile, all across the Americas. But it's also marginal producers from the likes of Africa and China. And looking further out, this oversupply is likely to reduce price volatility, even pushing the market into a period of oversupply from 2024. But before you string me up or pelt me with rotten tomatoes, I'm going to show you how finely balanced the market is. And this is probably the most important thing I'm going to show you. So we went a little bit further than our base case and developed two scenarios. In the first scenario, light blue, this considers battery right sizing. And that is considering a slightly smaller average battery capacity within electric vehicles. And of course, that would go hand in hand with higher LFP uptake that Sam was referring to earlier, due to the lower battery capacities. The second scenario in yellow looks at an upside to electric vehicle uptake. Not much, only just a slightly optimistic upside by 2030. And don't be mistaken, these are entirely possible scenarios. You can see the severe effect that the market, that each of these scenarios has on the market balance. The former pushes the market into oversupply, suggesting a period of prolonged low market pricing, and the latter would be enough to hold prices high enough where it remained for most of 2022 throughout the forecast. And of course, persistently high prices, of course, is not a comfortable position for auto OEMs. And persistently low prices is not a comfortable position for miners. That does not encourage investment on the supply side. So I'd argue neither is sustainable. Here we're looking at the effect across a suite of metals that we cover at Crew. Of course, this effect does not only apply to lithium. As I said today, we're just using lithium as an example. But what I'm showing here is an indication of how much demand, battery demand, will grow for each of these metals by 2030. For lithium nickel, this is, of course, very apparent already. That's expected to triple by 2030. And for cobalt, the situation doesn't look as rosy. Most emerging cathode varieties will have less cobalt intensity, and we're also seeing higher manganese intensity across a variety of new cathode varieties that are being introduced. Manganese, of course, raises energy density and performance in batteries. So that's why that's happened. Manganese, that will drive growth almost sevenfold by 2030. For cobalt, that's less than 2 times by 2030. For phosphate, of course, with the introduction of LFP and LMFP cathodes, that will be a 5-fold increase by 2030. What I'm also showing here is the upside effect to each of these battery metals and the downside too. And you can see in any of these scenarios that demand by 2030 is significantly higher in either the high case or the low case. So the reality is that very minute changes to the landscape of battery technology, as well as the uptake of EVs, can move the market from surplus to deficit. And that ultimately impacts prices for each of these commodities. It's very clear, though, that in almost every case, we'll see rapid growth in demand for any materials used within the battery sector. Even in the case of thrifting, substitution, and a slower transition to a clean economy. The warning, however, is that commodities most dependent on battery demand will see the greatest price volatility. And that puts the prospects of marginal producers at the mercy of the market. And marginal producers refers to those dependent on lower grade or smaller resources in difficult locations using more costly extraction technologies. That's it from us. Thank you for your time today.
Any questions now for the guys?
We heard earlier today from Alliance Nickel that their off-taker was an auto OEM is going to help finance their mine. Is that a trend you're seeing now over the battery metals?
Absolutely. So the traditional way to approach this from the OEM side was just to approach miners and develop that memorandum of understanding, which is essentially just pen to paper. But I'm hearing more and more that these miners need capital in order to secure those. Thank you. In order to secure those those offtake agreements, and I think the requirements for mining investment is going to definitely encourage more and more of these sorts of agreements. Great question. Thanks.
So in the first part of the presentation, I think Sam's presentation, you have a comment about technical improvements can facilitate thrifting of all materials. So I'm just wondering what the practical and theoretical limits are in terms of just overall material reduction to achieve the same effect.
It would be difficult to quantify it really without giving a full breakdown, but generally speaking, we're seeing, despite what I mentioned or barely mentioned in terms of technical improvements, we're seeing diminishing returns at the moment. And I think the next sort of frontier in terms of energy density, because that's what ultimately enables thrifting, is energy density, among the other things. The next frontier of energy density is on the anode side, in terms of silicon and so on. But like I said, for EVs, and this opinion is shared by some silicon anode companies actually, in that we don't expect them to be, in terms of pure silicon anodes in EVs, don't expect them to be playing a huge role in the EV market. So yeah, it's ever diminishing returns. Next frontier is anode density, and most of the improvements and material thrifting in the past couple of years, or at least what's going to happen in the next couple of years as well, is around pack level energy density improvements. So I don't know if you heard about cell to pack and cell to body. So essentially, it's a way of integrating the battery cells within the vehicle instead of just fixating on the cell level energy density. Companies like BYD have pioneered these ways of making more efficient use of material and making more efficient use of the space within the battery pack, and that ultimately simplifies component usage and therefore material usage. Yeah.
So thank you for the discussion. The question from my side is, to what extent are you confident in the uptake of the electric vehicles in general? Because even what we see, there could be a recession. The significant amount of car market in USA is underwater, given the high debt levels, and the infrastructure is not as developed in Europe as maybe elsewhere in the world. So to what extent are you confident that the uptake in the electromobility will be as substantial as the politicians are sort of wishing for, right? So whether the actual capabilities of the consumer will limit to some extent the uptake in the sold cars.
Yeah. So as I said in the beginning, there are risks to both to the EV penetration forecast and to the total top line of the auto market, because if you make the crude assumption that these EV penetration targets cannot be met through most likely through a material supply demand deficit, then that means at the same time automakers have to meet their regulatory targets, and therefore, crudely speaking, the ICE vehicles also have to come down. And we're talking the major auto markets, China, Europe, North America. As for the confidence in it, like I said, there's downside risks. I'm probably not the best place to talk about the economic risks to it, but suffice to say, the auto industry has suffered through crisis after crisis since 2018, and one more of these, won't necessarily bring it to its knees, but there is a massive downside risk to the total top line in the major developed markets, so China, Europe, North America. Most of the growth post-recovery in the next few years in our forecast is coming from emerging markets, and generally they're not very regulated in terms of EV targets and whatnot. And generally speaking, with EV targets, it's we don't really take them for their word, take them at face value. Yeah. Hopefully I answered that question for you.
Thank you.